Welcome to the presentation of examination techniques on paper D5 International Taxation. My name is Abraham Chewe Mlolani, presenting these examination techniques. The outline of this presentation will cover the general competences required by the paper D5 International Taxation syllabus, the syllabus learning outcomes and the learning content, the examination paper, common weaknesses in the paper D5 examination, and finally, the examination techniques. General competences required. This paper introduces students to international taxation, taking a closer look at issues such as the following. First one, the global economic environment. Second one, history of international tax law. Third, double taxation conventions, abbreviated DTC. Fourth, treatment of income of non-residents, treatment of foreign income of residents. Fifth, transfer pricing and thin capitalization. Sixth, international tax avoidance. And seventh, indirect taxes in international taxation. What are the learning outcomes? The syllabus for paper D5 international taxation comprises 7 learning outcomes as follows. On completion of this paper, the student should be able to explain the features of the global economic environment, discuss the sources of international law and implications for Zambia, discuss the sources of double taxation and the reasons for double taxation conventions, calculate income tax for both residents and non-residents on worldwide income, discuss transfer pricing and thin capitalization, discuss the impact of international tax avoidance legislation for taxable persons, and lastly, apply indirect taxes to international transactions, including the role of the Organization for Economic Cooperation and Development, OECD, and the World Trade Organization, WTO. These are the learning outcomes which will be examined in the examination for paper D5 international taxation. But what is the learning content? The learning content is made up of 8 syllabus units. Each of these 8 syllabus units focuses on a specific learning outcome. Each of the units is subdivided into elements to indicate what specifically is expected to be covered under that particular unit. The syllabus units and their elements are covered in the next slides following below. Unit 1, Global Economic Environment. Under Unit 1, Global Economic Environment, the unit elements which should be covered are as follows. 1, theories of international trade and objectives. 2, counter trend. 3, foreign direct investment. 4, multinational companies and trade agreements. 5, regional economic groupings. And 6, globalization and its effects on the Zambian economy. These are the 6 elements under Unit 1, the global economic environment, which should be covered and on which we will be expected to answer questions when they are set. Next unit, Unit 2, History of International Tax Law. Under Unit 2, which covers the history of international tax law, the elements which should be covered are 1. They work under the League of Nations. 2. The work of the Organization for Economic Cooperation and Development, OECD. 3. Work of the United Nations Group of Experts. 4. The work of the European Union. It is very important that we understand the history of the international tax law, because this history is what guides us to understand what currently prevails in international transactions where taxes are expected to arise, so that we are able to understand why they arise in the way in which they actually arise. Third unit, Unit 3, Double Taxation Conventions, abbreviated as DTC. Double Taxation Conventions are signed by governments as a way of ensuring double taxation is avoided. And the elements under this unit are 1. Sources of double taxation, residents and citizens. Double taxation would arise because income which is being subjected to tax in Zambia has already been taxed elsewhere. 2. Role of double taxation treaties. The role of double taxation treaties is to ensure double taxation which would arise because income being subjected to tax in Zambia has already been taxed elsewhere from being taxed twice. So when there is a double taxation treaty, tax will only arise in one of the two countries, either in Zambia or in the source country where that income arose from. 3. Methods of giving double taxation relief. Methods of giving double taxation relief are commonly the use of treaty relief and the use of unilateral relief. Unilateral relief may be unilateral credit relief, or it may be unilateral expense relief. Unrelieved overseas tax. Unrelieved overseas tax is the tax paid abroad in respect of income received from a foreign source for which double taxation relief cannot be granted. This may be because the double taxation relief is limited, and because of that limitation, part of the tax paid abroad does not fall within the amount which is available for relief. How should this unrelieved overseas tax be accounted for? And lastly, the Organization for Economic Cooperation model. This is the model treaty produced by the OECD, which is usually used by various countries when they are developing their double taxation treaties. The fourth unit, Unit 4, Treatment of Income of Non-Residents. When we are looking at the treatment of income of non-residents, the main focus is on Zambia. We are looking at persons who are not resident in Zambia and where these persons receive or earn income. And the elements under this unit which will be covered are 1. Domestic employment income of non-residents, where an individual who is not resident in Zambia takes up employment in Zambia. How will this person be subjected to tax in Zambia? Secondly, domestic business profits of non-residents. This is a case where an individual who is not resident in Zambia commences a business in Zambia. How will the profits from that business be subjected to tax for that particular non-resident individual? 3. Domestic investment income of non-residents. This again is a case where a non-resident individual makes investments in Zambia and they earn investment income. These investments may be investments in real estate where the investment income is rent. They may be investments in shares of companies where the investment income will be dividends, or they may be savings with financial institutions where the investment income is in the form of interest. The fourth element is taxation of foreign income of non-residents. This involves the treatment of income that arises from sources which are outside Zambia and is received by a person who is not a resident of Zambia. How will such income be subjected to tax in Zambia? Unit 5. Treatment of foreign income of residents. This unit now focuses on how the income which is received from foreign sources by residents of Zambia should be charged to tax here in Zambia. The elements under this unit are 1. Resident individuals receiving overseas employment income. This is a case where an individual who is resident in Zambia takes up employment from within Zambia and they are seconded to work abroad. Then they continue to earn employment income. How will this income be subjected to tax in Zambia? In addition, it also includes cases where an individual is resident in Zambia, actually takes up employment outside Zambia, maybe for 6 months, for 9 months, and they earn employment income from there. How will such employment income be subjected to tax in Zambia? Number 2, resident individuals with overseas business profits. This is a case where an individual who is resident in Zambia runs a business outside Zambia, and that business produces profits. How will those profits be subjected to tax in Zambia? Alternatively, we may have individuals who are resident in Zambia but who set up a partnership outside Zambia with other partners who are not resident in Zambia. How will the profits from such a partnership be subjected to tax in Zambia on the individuals who are Zambian resident partners? Thirdly, the calculation of income tax for residents with worldwide income. How will tax be computed for individuals who are resident in Zambia and who receive income from all over the world, meaning from Zambian sources as well as from sources which are outside Zambia? Unit number 6, transfer pricing and thin capitalization. Issues to do with transfer pricing arise in situations where a multinational enterprise has establishments in Zambia and elsewhere. And in respect of Zambian establishments, either products are produced in Zambia and they need to be exported through transferring to other establishments of the enterprise abroad. When goods are being exported from the Zambian establishment of this multinational enterprise to other establishments of the same multinational enterprise, a system of transfer pricing will usually be used. Under this system of transfer pricing, the products from Zambia may be sold out at prices which are below their true market value as a way of ensuring that this multinational enterprise minimizes its tax payments in Zambia. Alternatively, the multinational may be exporting goods to Zambia from other countries where establishments of the same enterprise produce these goods. When this is the case, these goods will be exported into Zambia also at prices which will ensure that minimal taxes are paid in Zambia. To ensure minimal taxes are paid in Zambia, the prices will be inflated. But international tax legislation prohibit such practices under transfer pricing. So, issues concerning transfer pricing and thin capitalization are issues which are critical globally at the moment. Apart from the physical transfers of goods, other issues within transfer pricing involve making loans to related parties, which are the same establishments of a multinational in various countries. These loans may be made at interest rates which are inflated to ensure that a huge amount of profit is remitted out of Zambia to elsewhere through interest charges. Again, international tax legislation prohibit the use of such transfer pricing policies of inflating interest rates on loans to related parties. The specific elements under Unit 6 are therefore: 1. Determination of profits of branches and associated enterprises, taking account of the rules on transfer pricing. 2. Consideration of examples of domestic transfer pricing legislation. This is a consideration of the actions which have been taken in Zambia to ensure rules governing transfer pricing which are applied globally are also recognized here in Zambia and revenue is protected. Thirdly, transfer pricing and double taxation conventions as contained in Article number 9 of the Organization for Economic Cooperation and Development, MTC, Multilateral Convention. 4. The Organization for Economic Cooperation and Development Transfer Pricing Guidelines. 5. The consideration of examples of thin capitalization. And 6. Thin capitalization legislation and double taxation conventions. Thin capitalization legislation is put in place to restrict the extent to which interest which is being paid abroad is minimal. When there is a restriction on the amount of interest which will be paid by imposing a standard ratio of debt to equity, multinational enterprises cannot transfer their profits from Zambia to other countries where they will be charged to tax at lower rates. Unit number 7, international tax avoidance. Multinational enterprises take steps to avoid taxes internationally. Tax avoidance, as it is well known, is not a crime. All it does is involves is taking steps to minimize taxes by taking advantage of any loopholes within taxes legislation in various countries. And the elements under Unit 7 are, firstly, the identification of tax havens. Tax havens generally are those countries where there is no formal tax system, and because of the absence of a tax system, they are used as means of avoiding taxes. Income may be channeled to such countries so that it is not subjected to tax at all, or if there is any tax, it is subjected only to minimal taxes. How do we identify countries as tax havens? 2. Domestic law approaches to international tax avoidance. This is a consideration of steps which Zambia has taken to ensure that international tax avoidance is minimized. 3. Money laundering legislation and international tax avoidance. What does money laundering do as a way of ensuring that international tax avoidance is monitored? 4. Application of money laundering legislation to foreign fiscal offenses. 5. Cooperation between revenue authorities, where our Zambia Revenue Authority cooperates with revenue authorities of other countries, especially in the areas of information exchange, to ensure that any income which is received here in Zambia is income which other tax authorities have subjected to tax or have exempted from tax, to ensure that here that income is dealt with fairly, both from the point of view of the taxpayer who has received the income and from the point of view of the government of Zambia. 6. Conventions for administrative assistance in tax administration. Unit 8. Indirect taxes in international taxation. Indirect taxes are those taxes which are not imposed directly on the income or on the gains. These taxes by nature arise as a result of expenditure. As taxable persons spend on goods and services which are taxable, the indirect taxes are paid. They are part of the prices paid for these services and goods to which the indirect taxes apply, such as value-added tax. What are the elements under Unit 8? 1. The origin and destination bases for indirect taxes. 2. The General Agreement on Tariffs and Trade, GATT, rules and the limitation on border tax adjustments. 3. World Trade Organization rules, WTO rules, and taxes. 4. Cross-border measures. Measures involving two companies or more which are physically located in two or more different states. 5. The OECD Model Double Taxation Convention on estates and inheritances. This clearly arises in areas where there is a system of inheritance tax or a system of estate duty, which are applied on estates of deceased persons who are individuals. 6. Taxation and international human rights instruments. 7. The European and International Convention on Human Rights and Taxation. How do the human rights legislation interact with the European Convention on Human Rights? 8. The International Covenant on Civil and Political Rights and Taxation. And finally, 9. The treatment of foreign missions. The treatment of Zambian missions abroad, the treatment of missions here in Zambia of other governments from our tax administrators' point of view. These are the 8 units which make up the syllabus for paper D5 International Taxation, with each unit having a number of elements of the syllabus. The elements identify specific topics under that unit which must be covered. We move on now to discussing the examination paper for D5 International Taxation. The examination paper for paper D5 comprises 4 compulsory questions of 25 marks each. Questions in this paper mix computations and narrations, which may be descriptions, explanations, and discussions. Therefore, it is not 100% computational. We will not have 4 computational questions, and it is not 100% discussion. We will not have 4 compulsory questions which are discussion based or narration based and so on. One question may contain both aspects of computation and narration. Other questions may be purely computational, others may be purely narrative. So questions can mix. Each question may have computations and narrations, or some questions may be purely computational, others may be purely narrative. The examination questions will generally cover all the competences at each sitting, meaning from the 8 units which we have identified, which make up the syllabus for this paper, we expect something to be examined. That is what is meant by the examination will generally cover all the competences. The pass rate for this paper is not 100%. Though it's not possible to achieve 100% pass rates, it is possible, however, to achieve higher pass rates than what is currently prevailing.
Are you a talented student thinking of a career in accountancy? Do you desire to develop a successful and internationally recognized qualification? CA Zambia will help you achieve your career aspirations. Make the right choice and shape your career in business and finance. CA Zambia, not just an accountant, but a chartered accountant. CA Zambia, developing business leaders.
The pass rates are lower because of some general weaknesses displayed by candidates which are identified by the examiners as marking processes go on. We'll go through these general weaknesses which are displayed by candidates quickly. The first one is failing to use the taxation table provided. The examination paper includes a taxation table at the start before the commencement of the questions. Candidates do not refer to this taxation table as they attempt questions. They use tax rates which they believe are the rates applicable, instead of using the rates which are provided for that examination. The second weakness is failing to attempt the required number of questions. We mentioned that there are 4 compulsory questions. Candidates are therefore expected to attempt all the 4 questions. A weakness is candidates may attempt 3 questions, or they may attempt 2.5 questions. Attempting less than 4 questions reduces the chances of passing. The third weakness is failing to answer the question set, and therefore providing answers to questions which the candidates expected were set. Questions will specifically require particular computations or particular explanations or discussions. Candidates must clearly perform the specific calculations asked for, or provide the specific discussions which have been asked for. A question that asks for a discussion will require the answer in the form of a discussion and not calculations. A question that asks for an explanation will require the answer in the form of explanations and not calculations. The fourth weakness, poor presentation of answers. Candidates present answers in a manner that is difficult for markers to follow. The answers must be written for each question chronologically, A, B, C, D, in that order, from one page to the next page continuously. Some answers we'll have one part on the first page of the answer booklet, another part on the 6th page, and so on. In addition to that, the way the answers are presented may make it difficult for markers to follow. Number 5, poor handwriting. When the handwriting is poor in such a manner that markers find it difficult to read, then awarding of marks becomes a challenge. Candidates should practice writing down answers to questions within a period of 3 hours so that in the exam, the handwriting is maintained as they attempt the questions. Poor command of the English language. This is where candidates provide explanations which are ambiguous, making it difficult for markers to award the marks. Specific weaknesses which relate to each individual unit. Starting with Unit 1, the global economic environment. Under Unit 1, each time questions have appeared under this unit, candidates usually provide good answers. The only main weakness is failing to address the requirement verbs used. Requirement verbs used will be considered, and candidates will therefore be expected to interpret and apply them correctly. This aspect of Unit 1 usually being dealt with well is a welcome move, and candidates are encouraged to keep it up. Unit 2, History of International Tax Law. It seems candidates find this unit of the syllabus relatively easy, and there are no areas of concern to bring out at this time. Candidates are encouraged to keep it up. Unit 3, Double Taxation Conventions. The main weakness faced in this area of double taxation conventions relate to understanding the terminology used. It appears candidates do not clearly understand the terminology relating to double taxation conventions. The terms double taxation convention, double taxation treaty, bilateral treaty, multilateral treaty all refer to the same thing. Double taxation conventions may be bilateral treaties if they are made up of two states, State A and State B. They are multilateral treaties if there are 3 or more countries or states involved. So the terms all refer to a treaty or a convention which has been signed as a way of minimizing double taxation relief. Let's look at an example involving double taxation relief. There is no scenario. There are 2 parts required. A, define double taxation relief. B, explain 3 methods of giving double taxation relief. Before attempting to answer this question, we can look at some comments regarding how candidates fared when this question was examined. In Part A, candidates mistakenly defined double taxation instead of defining double taxation relief, because the question has not asked for a definition of double taxation. it has asked for a definition of double taxation relief. In Part B, candidates mistakenly mentioned the three methods without explaining the circumstances under which each of them apply. Part B of the question asks, explain three methods of giving double taxation relief. As the explanation is provided, the candidates are expected to provide detailed explanations to show when each of the types of double taxation relief applies. It's not the same as mention three methods of giving double taxation relief. The explanation will require the methods to be mentioned and when each of these methods is applied. The answer, which is suggested solution: A, the definition. Double taxation relief is a relief that is given to eliminate the effects of double taxation in a case where income being charged to tax in a country has already been charged to tax in another country. If double taxation relief was not available, taxable persons would bear too much tax on the same income, as that income would then be subjected to tax in several countries. That is the meaning of double taxation relief. It is a relief that is given to eliminate the effects of double taxation. Double taxation would reduce income significantly. When it is eliminated, income will be reduced only in the manner that it would if tax was charged on it only once. Part B. Three methods of giving double taxation relief are treaty relief, unilateral credit relief, and unilateral expense relief. Treaty relief is applicable where there is a double taxation convention between two countries. The treaty would provide for how the relief would be granted on intercountry income. The methods under which the relief would be available may be by way of exemption, where income subjected to tax in one contracting state would be exempt from tax in another contracting state, or by way of credit, where tax already paid on the same income in one contracting state is given as a credit against tax payable on the same income in another contracting state. Those are just examples of how treaty relief is given. Where income received in Zambia has been subjected to tax in another country, where treaty relief applies, there may not be any tax to be charged in Zambia. Or the tax already paid abroad will be credited against Zambian tax on that income if that is what the treaty between Zambia and that other country has provided for. Unilateral credit relief applies where there is no double taxation convention. In such a case, double taxation relief may be granted unilaterally in the country where the income is received by crediting against the tax charged in that country the amount of foreign tax paid, if lower than the local tax payable. And lastly, unilateral expense relief is also available where there is no double taxation convention. In this case, double taxation relief is given unilaterally in the country where the income is received by treating the foreign tax paid as an allowable expense. Ideally, unilateral credit relief and unilateral expense relief are both granted where there is no double taxation convention between two states the state where the income arises from, which is the source state, and the state where the income is received, which is the state where the person who has earned that income receives it in. So methods available for granting double taxation relief are treaty relief, which applies where there is a double taxation convention, and unilateral relief, which may be unilateral credit relief or unilateral expense relief, which apply where a treaty does not exist between the two states involved. Unit 4, treatment of income of non-residents. This unit focuses on how income earned by non-residents in Zambia is dealt with. As we said earlier, these are individuals who are not resident in Zambia or enterprises which are not resident in Zambia but which earn income either from Zambian sources and deemed Zambian sources or from abroad. In some cases, candidates fail to distinguish between taxation of income derived from Zambian sources and taxation of income derived from deemed Zambian sources, where the person receiving the income is a non-resident. And this is the only weakness. Where the person receiving the income is a non-resident, that person will only be subjected to Zambian tax on the income if it has a source in Zambia. If the income has a deemed Zambian source and that income is not received by a resident person, that income is not subjected to tax. The non-resident will not be subjected to tax on income that is derived from a deemed Zambian source. The source of the income must be a Zambian source. For example, due to globalization, there is an increase in non-resident individuals and businesses earning income from many sources, including sources outside the states where they are physically present. Required. Explain how each of the following types of income received by non-residents is normally treated for taxation purposes in the home country. A. Domestic employment income. B. Domestic business profits. C. Domestic investment income. D. Foreign income for non-residents. There is a short scenario. It tells us due to globalization, there is an increase in non-resident individuals and businesses earning income from many sources. By many sources is meant sources from many countries. We are asked now to explain how each of the following types of income received by non-residents is normally treated for taxation purposes in the home country. The home country in this case may be Zambia. Domestic employment income, where a non-resident takes up employment in Zambia. Domestic business profit, where a non-Zambian resident takes up a business in Zambia. Domestic investment income, where a non-resident makes an investment in Zambia. And foreign income for non-residents, where a non-resident earns income from abroad. This question may be based on the law as it applies in Zambia. Here, primarily, it is the source of income that determines whether it is chargeable to income tax or not, while the residence status of the person who has earned that income is secondary. Countries where the primary factor is residence consider the residence status before establishing whether income shall be chargeable to tax. So here in Zambia, if income is derived from a Zambian source, it is taxable. And if the income is derived from a deemed Zambian source, it is taxable if the person who has earned it is resident in Zambia. In states where residence taxation applies, persons are chargeable to tax by reason of being resident, irrespective of the source of income. Meaning, residents in that case are chargeable to tax on the income from all over the world. Suggested solution: A. Domestic employment income is chargeable to income tax in Zambia, even if the employee has been in Zambia for less than 183 days in the tax year. This is because all income that has a Zambian source is chargeable to income tax in Zambia. Withholding tax would be charged on such income at source. B. Domestic business profits are chargeable to income tax in Zambia because they have a Zambian source. C. Domestic investment income is chargeable to income tax in Zambia. It has a Zambian source and therefore withholding tax will be deducted at source. D. Foreign income of non-residents is not chargeable to income tax in Zambia. This is because such income has a source outside Zambia. Such income is not chargeable even if it is received by way of interest or dividends. This distinguishes between how a non-resident will be subjected to tax here in Zambia on income that has a Zambian source and on income that has a non-Zambian source. Unit 5. Treatment of foreign income of residents, where a person is resident in Zambia, whether an individual or a person other than an individual, and such a person earns income from abroad. Here the main problem faced by candidates is the determination of the amount of tax to be credited under unilateral credit relief, where there are two sources of foreign income, or even more than two sources. Many candidates perform one computation of the amount of Zambian tax charge attributed to the foreign income when there should be separate computations where each foreign source has an amount of Zambian tax attributed to it. The other common mistake is the inclusion of foreign rent received when computing Zambian income tax. Foreign rent is specifically exempt from income tax in Zambia, whether it is received by an individual or by a person other than an individual. So candidates should note that foreign income is only taxable if it has a deemed Zambian source. The foreign income which is deemed to have a Zambian source has been defined within the Income Tax Act.